Joining us now for more is Mark Lucchini. He is Chief Investment Strategist at Janney Montgomery Scott. Also here with us is Bill Strazzullo, Chief Market Strategist at Bell Curve Trading. Guys, welcome. Happy New Year. Mark, doesn't a lot here depend on whether the price to earnings multiples stay kind of rich in 2025? I know you think it's a good year ahead, but what influences whether those multiples stay strong?
Well, John, Happy New Year to you as well. Two things. One, certainly earnings that are expected to grow at a mid-teens pace by most aggregator services. And so in order to achieve the kind of gains that I think a lot of strategists, including us, have largely penciled in, it's not going to be, as you said, due to multiple expansion. Over 50% of the returns generated over the last couple of years has been due to PE expansion, not just earnings doing the heavy lifting. I think that's going to be reversed this year. So as a consequence of that, and the other, of course, being an economy that remains relatively stout. Right now, we're seeing the Atlanta Federal Reserve's GDP Now tracker posting up at 3.1% annualized. That would be an extension of what we saw in Q3. And if that's the case, certainly a lot of momentum going into 2025, which is a pretty good setup for stock prices overall, even if we don't get further multiple expansion. Okay, well, conversely, Bill, you think the stock rally is pretty much over. So how should investors position themselves heading into 2025? I mean, raise some cash?
Yeah, John, I'm going to take the other side of that all day long. Look, you know, we've been one of the most bullish firms on Wall Street for the last year and a half. I've talked about it a number of times on this network. S&P going to 6,000, NASDAQ 100 going to 22,000, 22,500, Dow going to 45,000 to 47,000. And that seemed like a pipe dream 6 months or a year ago. But we're here, and those are the targets off the critical March 2020 lows, the pandemic lows, which is the key long-term trend driving the markets. You know, everybody comes on these shows and says, I'm a long-term investor, but if you want to stop an interview in its tracks, ask them, what's the long term? Is it 3 years ago, 5 years ago? Is it 1929? But the key driver here is really off the pandemic lows when we had the historic massive monetary and fiscal stimulus. And when you look across the major U.S. equity indices, it's basically tapped out here. You know, Wall Street is looking for the economy to stay strong. Great. I mean, that's in the market. Fed rate cuts in the market. Trump administration to be more pro-business in the market. 90 to 95% of it is in the game now, in the market, and there's a lot more that can go wrong that can go right. So we're advising our clients, which are some of the largest mutual fund complexes, hedge funds, pension funds in the world, to pump the brakes and take your equity exposure down.
Okay, so are you just putting that into fixed income right now? Are you going into real estate? Where are you seeing other opportunities then, Bill, if it's not in the market?
I mean, Contessa, we advise all sorts of money managers that have all sorts of prospectuses. Some are long-only mutual fund complexes that'll raise cash. Other ones have broader mandates where they may sell calls, buy puts. You know, the defensive sectors will not lose as much as some of the more aggressive sectors, the Magnificent Seven, et cetera. But the point is that there is not much left here. You know, I could see maybe the S&P getting pushed to, 62, 6,300, maybe NASDAQ 122.5, but you're in the 8th or 9th inning here. And I think for the people watching the show, the other side of this is take advantage of what's been a great run. Take some chips off the table and take your exposure down. You're going to be able to put that money to work at much better levels later in the year.
Mark, do you think that, even if you think that the next year is going to go gangbusters, do you also think that there's going to be volatility and that you have to have some investing patience to get ready for 2025?
Well, certainly we've tempered our judgment relative to the expectations in the coming year. We certainly don't expect to see another what would be a three-peat of 20+% gains. We penciled in 6,600 as our central case, which is about 10% out of the money. But along the way, we expect far more volatility for some of the reasons Bill mentioned in 2025 versus what we've seen here other than the growth scare in August, where we had about a 9% pullback in equity prices in relatively short order. But a consequence of the fact that we have pulled forward a lot of news on certainly, receding inflation, Fed rate cuts that are underway, Certainly fiscal policy, where investors are focusing more on some of the pro-growth aspects of it, deregulation and prospects for lower corporate income taxes rather than tariffs and something untoward surfacing geopolitically or otherwise. And so those are all the reasons we would expect more air pockets this year, so investors may be able to take advantage, if they're nimble enough, of opportunities to come in at lower prices. But I think the overall path is for higher.